Imagine that you invested into a coin that was worth $100. You buy one of that coin and then you lend it to a platform like Aave that gives you interest on that coin. For the purposes of this video, let's assume they give you 10% return on average each year. So at the end of the first year, you would have 1.1 coins, hopefully worth $110, right? Nope, because the coin's price dropped by half. And now you still have 1.1 coins, but they're only worth $55. Unfortunately, you earned interest, you gained free coins, but the overall value of your investment plummeted. Welcome to Whiteboard Crypto, the #1 YouTube channel for crypto education, and here we explain the topics of the cryptocurrency world using analogies, stories, and examples so that you can easily understand them. In this video, we're going to explain how to avoid impermanent loss when investing in a liquidity pool program, and we want to thank Yucca for mentioning this video idea in our Discord group. If you guys have any ideas for future videos, please leave them in the comments section of this YouTube video or go ahead and join our Discord for free. Let's dig in. First off, if you're new here, let's go over a review of what impermanent loss is. Impermanent loss is a very difficult concept for beginners to understand. If you do not fully understand this idea, you definitely need to go watch our specific video where we explain impermanent loss using simple terms and a few examples. In short though, impermanent loss happens when your investment loses money due to how liquidity pools work. So basically, you provide 2 coins or tokens to a liquidity pool. By giving the pool your coins, you are allowing traders to trade back and forth using your 2 tokens. And due to this, these traders will pay you a small fee. In fact, in most cases, you're not the only investor in a liquidity pool, and so all the investors will split up those fees evenly based on the portion of the funds that they contributed. So impermanent loss is the temporary loss of value that you experience when the 2 tokens that you invested in change in value relative to each other. So to put it simply, if one token goes up and one goes down, you will experience impermanent loss. If one token goes up and the other one stays the same, you'll have impermanent loss. And lastly, if one token goes down and the other one stays the same, you will also have impermanent loss. In short, you want them to stay roughly the same price or to both go up if you intend to make money while providing to a liquidity pool. So without further ado, let's get into 6 ways to avoid impermanent loss. Number 1, provide to stablecoin pairs. Since stablecoins don't really move in price, they are theoretically immune to impermanent loss. And because of this, many other investors have already maxed out these pools so that these pools give very small yearly rewards. Now it should be noted that investing in 2 stablecoins is probably the safest way to provide liquidity. You'll still have to watch out for any stablecoins that might collapse. For example, recently Iron Finance created a stablecoin that was giving out ridiculous rates for providing liquidity, and overnight the price of that so-called stablecoin dropped to $0. There are also many rumors that Tether is over-leveraged and printing too many Tether tokens, which could cause them to become unpegged to $1. In fact, we actually have an entire video over Tether. If you're interested, you can check that out. So even though providing to stablecoin pairs is, quote, the safest way, you are still exposed to risks. Speaking of risks, the second way to avoid impermanent loss is to avoid risky or volatile coins. Impermanent loss is maximized when a coin is volatile. Since stablecoins rarely move in price, the impermanent loss is usually minimized. However, this works the other way around as well. When a coin quickly changes in price up or down, you will experience quite a bit of impermanent loss. Many tokens that are new are quite volatile, and also tokens that have low liquidity are also quite volatile. In the same category, new and low liquidity tokens also seem to be more risky. So tip number 2 is to avoid these coins because even though they might have a high reward, they are filled with high risk. The third way to avoid impermanent loss is to provide when a coin price is low. So if you're just trying to make sure your impermanent loss isn't affected by the coin price going down, you can attempt to provide liquidity during a bear market. This way, you will earn a reward for providing liquidity while also gaining some price appreciation from the coins that you are providing to. Even though you are still going to experience an impermanent loss, you'd rather experience it when your total value is going up as opposed to going down. The fourth way to avoid impermanent loss is also a way to mitigate it, and that is to provide to places that offer extra incentives. So there is a new decentralized exchange called DeFi, and currently they are offering extra rewards for staking your liquidity provider tokens. These rewards are commonly referred to as liquidity mining rewards. So let me sum this up. Basically, you automatically earn rewards for providing liquidity from the fees that traders pay. For example, one stablecoin pair on DeFi right now is offering around a 5% return. However, the DeFi platform is also giving you their own native DeFi tokens in reward for staking that liquidity. Right now, there is another 55% APR for people that stake their LP tokens. Now, what this means is basically that you just have to lock those tokens up and not do anything with them to earn the rewards. Now, it's important to know that you are earning the token DeFi, and since DeFi is a very new platform, the token price could go to zero, meaning your rewards are speculative. And because of this, many investors advise trading a certain portion of those DeFi tokens for other tokens like Ethereum or USDC, especially if you're unaware of the project, but if you still want to provide liquidity and earn an incentive. So summing this tip up, if you add the liquidity provider fees with the extra incentive of those liquidity mining fees, this is a 60% APR for simply providing stable coins, which hopefully have almost a 0% chance of impermanent loss if they stay pegged to $1. The fifth way that we have found to avoid impermanent loss is to provide to a liquidity pool that isn't 50-50. So usually, when you provide to a liquidity pool, the ratio of tokens is 50-50, meaning that 50% is one token and 50% is the other token. This means that there is an equal share of both tokens, and theoretically, an equal risk. However, there are platforms that can change this weight or this ratio so that the risk is mitigated. For example, a platform called Balancer lets you do pairs like 80% and 20%, and even up to 98% and 2%. These pairs allow you to provide liquidity with a different probability for impermanent loss because a certain portion of that pool is either smaller or larger. Another platform called Bancor can actually automatically adjust its own weights. This means as time goes on, they may switch from 50-50 to 60-40 and then to 70-30. And at the current moment in time, we actually have not done too much research on the effects of this long term. But if you leave a comment below about wanting a video on Bancor and how it works, it'll let us know that there are people interested in the topic, and we will attempt to do the nitty-gritty research for you. But in short, changing the ratio in the pool from 50-50 to any other ratio can help mitigate your risk of impermanent loss if it is done correctly. Lastly, number 6, providing to a pool that isn't just 2 assets. So there are actually liquidity pools out there that have much more than 2 assets, some all the way up to 8 and even higher. The math performed so that these pools work out is quite complicated and out of the scope for this simple video, but it is our job to educate you on the ways to avoid impermanent loss. And this is simply one of the tools in the book. Providing to a liquidity pool that has multiple assets will reduce your risk if one of the assets is quite volatile.